differences of all identified assets and liabilities. Okay, is that understood? Yep, all right. So the last little, fresh piece of knowledge, if you will, is the situation involving a variable interest entity or a special purpose vehicle. So I wanted to demonstrate what really happens there. And I've got this little example. So there's two companies, Beneficiary Inc. and Special Inc. They had the following balance sheet information on December 31st, 2001, and their associated fair values before the business combination. Now, Beneficiary Inc., if you look at their balance sheet, looks pretty healthy. For Special Inc., if you look at their balance sheet, it looks a little bit troublesome in the sense that their retained earnings has a negative balance of 150,000. You look at all of their assets add up to 750,000. Their liabilities have a book value of 800,000. So just going by book value, Special Inc. seems to be in trouble. It seems to be underwater because its shareholders' equity is actually a negative amount. 100,000 in common shares, an accumulated deficit of 150,000, you're looking at negative shareholders' equity, negative net book value of $50,000. So this company seems to be in a little bit of trouble. Now, you're given some information here. The market price of Beneficiary's shares were $10. Special is a private company with no publicly issued shares or debt. So that means it doesn't have any publicly traded financial instrument out there, so likely does not use IFRS. Special Inc. has an unrecorded development asset with a fair value of $150,000. Okay. So what happened is, after close of business on December 31st, 2001, Beneficiary entered into a contract with the common shareholders of Special, right? So these things are not forced down anybody's throats. There's negotiation. So, if you were just to think about what might be happening at Special Inc., their liabilities are greater than their assets, at least by going by the balance sheet information. So maybe the creditors are getting a little bit antsy. Maybe, if there's big creditors like the bank or whatever, they want to call in their loans. And if this company doesn't pay the loan, then it might be forced into bankruptcy, right? So it is facing a sort of a going concern threat here. The shareholders of Special Inc. are sort of underwater. Their equity is essentially wiped out, right? They've got negative equity in this particular situation. So one choice that they have is basically to fold up the business, be done. Now, sometimes, you could be in a situation where the company has some promise. It's just the promise has not yet gotten to a point of fruition. Hey, let me just check if you're recording, because I don't want to. Oh yeah, you're recording. Okay. So what happened is that Beneficiary got into an agreement, contractual agreement, with the common shareholders of Special Inc. And what does Beneficiary do? Beneficiary, so if you look at Special, Special seems to be kind of low on cash, right? So Special only has $25,000 of cash. That's quite low, right? Not enough. They don't have any other current assets, right? So uh, current assets kind of indicate your liquidity. So if it doesn't have current assets, it means it might not have enough of resources to kind of sustain its cash burn rate. Every company has a cash burn rate. They need to be able to pay their bills on a regular basis. So $25,000 cash might not be enough. So they needed some cash, and they can't really go out and borrow more money because creditors will look for security, and currently their assets are just not enough to provide that kind of security. So beneficiary will put in $100,000 in cash. Okay, so that will help boost the cash position for special link. They also agreed to guarantee the outstanding debt. So $800,000 of debt that the special link has. Beneficiary says we will provide a guarantee. Now, if you look at the balance sheet of beneficiary, it's considerably healthier, right? Considerably healthier. Their shareholders' equity is quite healthy, etc. So if they were to provide a letter of guarantee, you would imagine that the bankers will accept that guarantee, right? Guarantees are legally enforceable. So if Beneficiary Inc., prepares a letter of providing guarantee, that is legally enforceable. So the creditors of Special Inc. will feel like they got some security, and so maybe they'll stop harassing Special Link, right? They will at least not force Special into bankruptcy. So guarantee the outstanding debt. And to the beleaguered common shareholders who have got negative equity at this point in time, when you have negative equity, you don't really hope to get any dividends, right? Remember, dividends can only be paid out of retained earnings. If you don't have positive retained earnings, then dividends can't be paid out. So these guys, the common shareholders of Special, aren't really getting any dividends right now. In comes beneficiary as a knight in shining armor and says, "We'll give you guys a guaranteed annual dividend of $40,000." And the agreement says this $40,000 is equal to 10% of the agreed upon value of the common shareholders' equity position. So what that means is $40,000, the promised dividend of $40,000 is actually 10% of the value of the common shareholders' equity. So 40,000 is 10% of what, if I was to ask you? How much is the equity of the common shareholders being valued at? $400,000. Correct, absolutely. Now, I should have added another sentence. What's missing in the sentence is, why would beneficiary do this, right? Why would Beneficiary Inc. do all of this? What is beneficiary getting in return? And so what typically happens under these conditions is Beneficiary Inc. will promise to do all of this in return for all of the future profits of Special Inc. Beneficiary says, we'll put in $100,000, we'll guarantee your debt, we'll give your common shareholders $40,000 of dividends annually, which is, in our opinion, equal to 10% of their, their stake. But in return, we get control over Special. And the definition of control includes the ability. So A is having control over the activities, and B, having risk, having exposure to variable returns. Variable returns means there could be times when you'll have a profit, there could be times when you have a loss. So you have exposure to those variable returns. And thirdly, you have the ability to use your power to influence those returns. So what beneficiary will do from this point onwards is say, we will take over control, right? We're cleaning up your mess. We'll take over control. Now, look very carefully. Beneficiary is not seeking to purchase the assets and liabilities. So this is not a purchase of net assets. Beneficiaries also not looking to buy common shares of Special. This is not control by way of purchasing shares. What's really happening is by means of this contract, beneficiary is taking over control of special. So Beneficiary Inc. will now be the controlling party over special. Yeah. So that's what beneficiary is getting, control over special. How? By means of this contract, right? This, what was the name of that guy that was, once upon a time was the guy that used to write up contracts. Anybody watch Once Upon a Time? I'm forgetting. Rumpelstiltskin. Yeah, yeah, absolutely, Paige. That's yeah. No, I think you got it right. Yes, Rumpelstiltskin. Yes, I think that's how it was spelled. But anyways, yeah, so you kind of get the picture. So Beneficiary Inc. is coming in, helping out special, but there's always a catch, right? So there's always a catch. If beneficiary is going to now enjoy all the future profits, if there are ever any profits, we don't know. There's never a profit, a promise, but I'm sure Beneficiary Inc., management at Beneficiary Inc. would have done the math and so on. So if they will now get all the possible future profits or suffer losses, as the case might be, they're essentially taking over the risk. And in fact, they are becoming the equivalent of common shareholders, because that's precisely what common shareholders do. Equity holders, common shareholders, are the ones that assume the maximum risk and therefore also are eligible for the maximum rewards, right? That's the whole point of having an equity stake. If you have an equity stake, you're saying for better or for worse, I'm taking the risk. So beneficiary is taking over the risk. Now, on paper, or from the point of view of the law, legally, the common shareholders of Special Inc. are the equity holders, right? Legally, in the eyes of the law or on paper, these common shareholders of Special Inc. are the equity holders. But what's really happening? Beneficiary, in coming in and saying, you know what, you don't have to worry about the debt. We will guarantee you an annual dividend, right? A guaranteed annual dividend. That's no different from preferreds, isn't it? Preferred shareholders get a guaranteed amount of dividend, right? They're not really taking on much of risk because somebody else is the residual claimant. Somebody else will assume the risk. Yeah. So these common shareholders of Special Inc., because they no longer are taking any risk and they are being relieved of all the worries, what's really happening is they are ceding control. They will no longer have control over special. So although on paper they're still equity holders, the reality will be that going forward, the common shareholders of special are just going to be simply non-risk taking, not in control. And we have a term for that, right? So shareholders that are not in control, what do we call them? Absolutely. Non-controlling interest, NCI. So that's the beauty, that's the brilliance of this setup. We didn't we didn't buy, so Beneficiary Inc. didn't buy all the assets and liabilities. Not a purchase of net assets. They didn't buy any shares. It's not a purchase of common shares, but they still managed to get control. How? By means of a Rumpelstiltskin-like contract. And so the existing common shareholders have now been relegated to the position of non-controlling interest. This is the third way in which a business combination takes place. We've already seen an example of purchase of net assets. We've seen an example of purchase of common shares. This is the third case where you have business combination taking place through a contractual arrangement. So in this particular case, right? So what was the jargon? If you had a purchase of net assets, the buyer company, we call them the acquirer, and the seller company, we call them the acquiree. And there was no consolidation needed, right? Consolidation needed? No. In the case of purchase of shares, the buyer company is called the parent. There's no seller company, but rather the bought company, if you will, right? So the purchased company. They are called subsidiary, and consolidation is needed. The parent company needs to prepare consolidated financial statements. In this third case, when you have a contractual arrangement, there is no buyer as such, but the person who's taking control, right? So I hope you will not get lost. There's no purchase that's taking place, but consistent with what you had. So whoever took control, right? Party who took control, right? Party taking control. Party taking control and party being controlled. Well, actually, there's no control in the case of purchase of net assets. I don't want to confuse you guys, but hope, will you be too confused if I just left it as this: buyer, purchase, and consolidation, needed or not? Like, net assets is really not about control, because net assets results in physically taking over the assets and liabilities. So that's really not an issue of control. Purchase of assets, purchase of shares rather, results in control and needs consolidation. So I should probably write, yes. So this is physical control over assets and liabilities. In the case of purchase of shares, it's not physical control, but it's control over the subsidiary. And in the case of the contractual arrangement, we call the buyer, or the so-called, the party that takes over control is called the primary beneficiary. Primary beneficiary or sponsor, right? So that's the terminology used. Wrap, text wrapping, wrap. And the acquiree or the purchase company is called a variable interest entity or special purpose entity. And again, consolidation is needed in this case because the primary beneficiary has control over the VIE, the variable interest entity. Okay, so in this case too, consolidation will be needed because the primary beneficiary gets control over the variable interest entity, the VIE. So what's that jargon to do here? Beneficiary is the primary beneficiary, and special is basically the special purpose entity, or the VIE. Okay, so is the relationship okay between the two companies? What's their relative situation? Yes, no, maybe so. Okay. So how do we go about preparing the consolidated balance sheet? Step one, well, of course, you have to identify whether this is, so you have to identify the primary beneficiary, which is fairly straightforward here. It is Beneficiary Inc. Step two is the calculation of goodwill. If there is goodwill, right? So if there's any, or gain on acquisition. We don't know what the situation might be. Now, this calculation is different. Okay, this calculation is slightly different from what we learned for purchase of shares, because there's no purchase of shares taking place here. Here, on the other hand, you want to compare the consideration received, or rather, I should look at it the other way, the consideration given up. You want to compare that to the consideration received. If the consideration given up, if the consideration given up is more than the consideration received. So if the difference is positive, if what we gave up is more than what we received, if the difference is positive, then this will result in goodwill. If, on the other hand, the difference is negative, which means how will it be negative? It can only be negative if the consideration received is greater than the consideration given up. If the difference is negative, then it will be a gain on acquisition. If there is no difference, then of course there is no goodwill or gain on acquisition. And then step three is, I guess as part of step one, rather, we should calculate NCI. NCI is basically the agreed upon value of the current common shareholders of the VIE, variable interest entity. That's how much non-controlling interest will be. Value of NCI is the agreed upon value. So when you're looking at consideration given up, for example, what does that mean? The consideration given up is basically equal to, equal to the carrying value of any assets given up, carrying value of assets given up, so in this case, it was cash, right? So they gave up cash, plus the agreed upon value of NCI. That's what you're giving up. So if you transferred any assets, you'll take that into account, plus the agreed upon value of NCI. Now, when you're looking at consideration received, it's equal to carrying amount of assets given up plus fair value of net assets of the VIE. Now, I'm sure you will notice carrying amount of assets given up don't really matter, right? Because both the consideration given up and the consideration received has that piece. So there's not going to be any difference because of this piece, right? So the $100,000 that beneficiary is planning on injecting into Special Inc., this $100,000, because it is going to be included in both the consideration given up and the consideration received, it's going to cancel out. So what is really going to drive the difference is the value assigned to non-controlling interest and the fair value of the net assets of the VIE. If the NCI agreed upon value is more than the fair value of net assets, the difference will be goodwill. If, on the other hand, fair value of net assets of the VIE is more than the agreed upon value of non-controlling interest, then you're going to get a gain on acquisition. Okay. Now, step 3 is you prepare the consolidated balance sheet. And when preparing the consolidated balance sheet, you just need to remember to eliminate the variable interest entities shareholders' equity. Get rid of the shareholders' equity and any existing goodwill of the VIE. If there's any existing goodwill, that would need to be wiped out as well. You need to eliminate those. Include NCI and any value for goodwill calculated in step 2. If there's any goodwill resulting from the business combination in step 2, and add together, right? So you'll be eliminating these two, and while consolidating, you're going to be adding together, add together the balance sheets for the primary beneficiary and the VIE, the variable interest entity. Subject to these adjustments, you need to eliminate the shareholders' equity, the existing goodwill, if any, on the books of the variable interest entity, include non-controlling interest and any value for goodwill from step 2, and fair value differences identified. If there are any fair value differences, then those fair value differences need to be included. All right. So should we attempt the question? Should we attempt to prepare a consolidated balance sheet for beneficiary? Think you could handle that? Okay. So I've reproduced the balance sheet informations here. So they're a little bit handier to work with. We're going to do first, we're going to do step 1. So step 1, so this is the solution, right? So this is solution to sample 6.9 here. Step 1, Beneficiary Inc. is the primary beneficiary. And NCI, non-controlling interest, is, you folks calculated it for me, the $40,000 dividend that they are guaranteed to receive. It was told that that is 10% of the agreed upon values. You divide the 40,000 by 10%, you get the agreed upon value for NCI, $400,000. Right, so that's step one. Step two, consideration given up. Well, what does that include? Well, they gave up cash, 100,000, and they agreed to a value of non-controlling interest, 400,000. The guarantee really doesn't have any amount. Now, you could calculate a probability of the guarantee kicking in, and that could be added to the consideration given up as well. All right. So over here, I'm ignoring the guarantee. Just make a note of that. I'm ignoring the guarantee, but it may be needed to calculate. We may also, or rather, I think we'll be expected to, when you're providing a guarantee, you should calculate the expected amount to be paid out for that guarantee. We may also include an expected amount for the guarantee, the debt guarantee, basically the guarantee for. So I'm just excluding that for simplicity, right? I'm just keeping things simple here. Consideration given up, $500,000. Consideration received, well, the cash that I'm injecting, now that I will be able to control, beneficiary is going to control special, the cash that beneficiary is injected into what you may call it, beneficiary, is basically going to be controlled by that beneficiary injected into special will be controlled by beneficiary. So that 100,000 is also part of the consideration received. That's why I said, the cash that you, or any other asset that you happen to inject, that's not going to cause the difference, but you still have to formally include it in the definition. And then fair value of net assets. So fair values of net assets. So what are the net assets? For special, they have cash, they have land, PP&E, and intangible assets. So they've got cash, land, PP&E, intangible assets, and they have liabilities. So cash, beneficiaries' cash has a fair value of 25,000. The land for beneficiary has a fair value of 100,000. PP&E has a fair value of 650,000. So 100,000, 650,000. The intangible assets have a fair value of $100,000. Special Inc. also has an unrecorded development asset with a fair value of 150,000. So they've got intangible assets on the books that have a fair value of $100,000. But then they also have a development asset, which is also a kind of an intangible asset that's unrecorded, but it's been assigned a value. Now, why is it unrecorded? Because it does not meet the capitalization criteria for development, right? IFRS has got capitalization criteria. You may remember that from an earlier accounting course. It's because of that. However, assuming that that particular development has reached a certain maturity stage, that it's possible that it'll bear fruit, it'll become profitable, and so on. Whatever. Beneficiary believes that it's worth $150,000. And that's all that counts, right? That's all that counts. In the eyes of Beneficiary Inc., that development asset is worth 150,000. As far as Beneficiary Inc. is concerned, that 150,000 should be added to the intangible assets. So total assets works out to 1,025,000. Mind you, these are all at fair values, okay? It's fair value. The liabilities have a fair value of 800,000. So subtracting 800,000 from the 1,025,000, we get fair value of net assets, 225,000. Total added together gives me 325,000. So consideration given up 500,000, consideration received 325,000. There is a difference, and that difference is $175,000. This $175,000, my friends, will be called what? Goodwill. Exactly. That's goodwill. Okay. Now, once you've got that, then it's fairly straightforward. We can prepare a consolidated balance sheet. So that's step 3. It's going to be in the name of Beneficiary Inc. And so what do we have? We have these items. Just going to copy them. And the book values. All right, I just copied the information there. So this was the numbers for beneficiary. These are the numbers for special, right? And we're going to make some adjustments to these amounts, right? We're going to make some adjustments to these amounts to get to the consolidated amount. So adjustment, adjustment, and consolidate. Okay. Now, notice from the get-go that we're missing a spot for goodwill. So I'm going to add a line for goodwill. And we are missing a spot for non-controlling interest. And I'm going to include that non-controlling interest bit. And then, of course, the second thing is to just make sure that the math is working okay. And it looks like it's working okay. All right. So one thing that you got to notice is because our friend beneficiary promised to transfer $100,000 cash, their cash position will be lower by 100,000. So they had 200,000. Because they would have transferred $100,000 over to special, the amount of cash for beneficiary will be lower by 100,000. All right. Now that 100,000, how would they have recorded it? We're just trying to speculate. So if beneficiary transferred $100,000 in cash, that $100,000 cash injection, how did they record it? How would they have recorded? Because you credit cash, you got to debit something, right? So it is possible to include maybe an investment here, or you can consider that as a loan. We don't know, right? One of the two will work. Either it will be either as an investment or as a loan. So let me just make an assumption here. Assume, I just want to show you, assume the $100,000, maybe in the next iteration, I'll remember to add this part. Assume this $100,000 cash transferred by beneficiary is by beneficiary to special is a loan. Okay, it's a loan. So what would happen in that case? Like, let's say I don't want to go with it as an investment. I just want to show that as a loan. So how does that show up on the balance sheet then? There's a loan, beneficiary lent the $100,000 to special. How does that show up on beneficiaries' books? If beneficiary lent the money, what's the journal entry for that? Well, journal entry is you want to credit cash, 100,000. And if it's a loan, you maybe want to call it a note receivable, some kind of a receivable. It's an interest-free note. So yeah, I don't want to go down the path of, oh, we should do a present value, etc. Let's say it's an intercompany note, okay? So this would be the journal entry in the books of beneficiary. In the books of special, it will be debit cash and credit note payable. So looking at the balance sheet after the fact, beneficiary's cash will be lower, but then it'll have a note receivable. And this is how things can get interesting as you continue. So there's a note receivable from special of 100,000. Yeah. So cash went down, note receivable came up. What happens for special? Their cash position goes up by 100,000. So they had 25,000. Now their cash will be higher. There'll be 125,000. So of course, this balance goes up. And then in the liabilities, they'll have that note receivable $100,000. So they'll have a note payable here of $100,000. So their liabilities, which were 800,000, is going to go up to 900,000. Okay, so the balance sheets will still be balanced. All right. Now, if you had decided to record that as an investment, say, then there will be a line for investment in special. If that were the case, you'll still have to get rid of the investment in special, just like you did that for purchase of shares. I just wanted to avoid any purchase of shares in this example. It's not that there can't be any purchase of shares, but it's usually not a big amount, right? Like you get control not because you bought the shares, you get control because of the contract. That's what I wanted to establish. So I didn't want beneficiary buying any shares here, just to make it very, very clear that this is still possible to result in control. Yeah. So are you guys comfortable with my balance sheets before I consolidate. So these should be the balance sheets as a result of the $100,000 cash infusion. Journal entry, books of beneficiary, journal entry, books of special, I can't spell beneficiary. In books of special, it'll be debit cash and credit note payable. Yeah. So you guys satisfied with these balance sheets? Yes, no, maybe so? Okay. Now, to consolidate, I want to come back and add any. So if there's any intercompany, you must eliminate that as well. So any intercompany receivable or payable. This is something you learn in chapter 5, by the way, but we just got an opportunity for that here. So eliminate any intercompany receivable or payable. So is there any intercompany receivable and payable? You betcha, right? This $100,000 note receivable. Well, that's intercompany. You want to get rid of that. And from the liabilities, you want to get rid of $100,000. You want to get rid of those, the intercompany receivables. Next thing, what you want to do is you want to eliminate the shareholders' equity of special. So shareholders' equity of special, you want to get rid of that. So 100,000 common shares, you got rid by subtracting. The negative 150,000, you got rid of that by putting in a positive 150. That's what will result in getting rid of the shareholders' equity. All right. So eliminate the variable interest entity shareholders' equity. Existing goodwill, there was no existing goodwill, and you want to get rid of the intercompany receivable payable. You've done that. Now include the value for non-controlling interest. So you had non-controlling interest, you calculated NCI, $400,000. And goodwill, you want to include goodwill, the calculation was 175,000. You want to include that as well. All right. Now, what about the fair value differences? For that, you have to look at, so these were book values. The fair value differences for the assets, the fair value for the, for the inventory. The fair value for the inventory was calculated, well, they didn't have any inventory. Okay, sorry. So they had land. The fair value for the land is 100,000. The book value is 75,000. So that would have been understated. So a debit of 25,000. Like I should have done a line, sort of a calculation for the fair value differences separately. But anyhow, hopefully you will forgive me for that. The PP&E has a fair value of 650, book value of 600,000. So that's an extra fair value difference of $50,000. The intangible assets had a fair value of 100,000, book value of 50,000. So you need to add another $50,000. For liabilities, you look at just the book values here, they were equal, right? So there was no difference as far as the liabilities were concerned. So I don't have to worry about the fair value difference for the liabilities. Now it's just a matter of adding together beneficiaries numbers, specials numbers, and any adjustments that you decided to make. So after all is said and done, total cash, consolidated cash is going to be 225,000. Total accounts receivable, 150,000. There will be no note receivable on the consolidated balance sheet. Inventory will be 250,000. Land will be recorded at 250,000. And that's basically the parent's book or beneficiary's book value and specials fair value. 150 plus 100. Well, that gives you the 250,000, right? So if you want to like do it faster, what you can do is just take the purchaser's book values and the fair values of the acquired company. PP&E similarly is 1.4 mil, intangible assets 100,000, goodwill 175,000. All said and done, you get total of assets on the consolidated balance sheet, $2,550,000. If you calculate the liabilities and equity, we get $2.7 million. So obviously I'm missing something. What am I missing? What am I missing? What am I missing? I'm out by 150,000. Shouldn't happen. Should have prepared a solution before doing it in class, eh? Oh, this blessed development asset that we allocated 150,000. Harjinder. So there was a development asset. So there is this guy and there is that 150,000 for the development asset. So that's because that's not on the books, right? You have to put in $150,000 for that development asset. If you like, we can add a line for it. So maybe if that would help you remember where that came from, maybe I can add a separate line for that. Development asset. There was nothing on their books, but then you added $150,000 for the development asset, and that makes your balance sheet balance. Thanks, Sheeta. Yes, that's the development asset that I was missing. So consolidated balance sheet, 2.7 million.